Hello, my name is PUSPITA from Class A. Study number is 78. Today, I want to read an article called Exchange Rate for the Final Exam. Exchange rate. A Bretton Woods agreement of the 1994 established fixed exchange rate, defined in the term of the gold and the US dollar between 1994 and 1971. Many currency were pledged against the US dollar. Their parentheses with the US dollar were fixed, and this period of a US dollar was a promissory note issued by the United States Treasury. If anybody requests it, the Treasury has to exchange the note for a half of an ounce of gold. Under this system, overvalue or undervalue currency could only adjust between the agreement of the International Monetary Fund. Such adjustments we are called the deflation and reflation. The Bretton Woods system of the gold coverability and pledging against the dollar was abandoned in 1971 because the following inflation, the Federal Revolution did not have enough gold and graduate in the American currency. Gold coverability was replaced by a system floating exchange rate. Today, the US dollar, the unofficial world currency, is merely a piece of a paper on which is written "In God we trust." God, not God. And a freely or clean floating exchange rate is determined purely by supply and demand. The theoretically, in the assessment of speculation exchange rate should reflect push changing power fallacy, the cost of a given selection of goods and service in different countries. Proponents of floating exchange rate, such as in Milton, France, argue in a currency would automatically establish stable exchange rate, which is would a reflection economic realities more appreciated than calculation by central banks official. Yet they underestimate the impact of speculation and the fact that companies and investors frequently follow short-term money market trends, even these are contrary to their own long-term interests. In the late 1970s and early 1918, the American, British, and the other government degraded their financial system and abolished all the exchange control. Residents in this country are not able to exchange any amount of their currency for any other's comparable currency. This has led to the current situation, which is 9/15 of the world currency transactions are unrelated to transaction in goods, but are purely speculative. Amounts of the money move around the world. Crashing high interest rate of the capitals again as investors, including rich individual companies and pension funds, seek to maximize the value of the rich asset. In London, in the late 1970s, $300 billion worth of currency was traded on the average day, the equivalent of about 13% of the value the goods Britain produced each year. Banks of equipment crews make a profit for the spin with a currency buying and selling price. Few governments, however, leave exchange rate fully at the mercy of market force. Most of them attempt to influence the level of the currency when necessary. Manage of dirty floating exchange rate are more common than purely floating ones. For example, in the 1918, most Western European governments joined to the EMS, which is established parenthesis between member currency. There was also and the exchange rate mechanism (ERM) of the rate difference by the more that plus or minus 0.5% for the central parity. Central banks had the intervened an exchange market, buying or selling in the other into usage or disage the value of the currency. Yet international speculation can be more powerful than governments. For example, on a single day in September 1992, the Bank of England lost 50 billion pounds in a hopeless attempt to support the pound sterling. For weeks, all the world financial institution and the rich individual has been selling their pounds. Has everyone except the British government believed that the pound has been seriously overvalued ever since its ability joined to ERM in 1991. When the British Central Bank ran out of reserve and could no longer buy pounds, the currency was drawn from ERM and allowed to float, instantly losing about 15% of its value against the D-mark. The next year, speculation attacked five other European currency and the Europe's monetary system was suspended. It was later introduced in the looser form. Many magnifers are the favor of fixed exchange rate and single currency, although it is possible to some extent to hedge against currency fluctuation by the way of the future contract forward. Planning is difficult when the price of raw material bulk from about or price of your product in export market can rise or fall by 15% in only a few months. Since exchange control we abolish currency including by US dollar and pound sterling have a term applied by up to 100 and then dispersed by more than 15% against the currency of major trading partners. Pressure from industrialists and governments led to the introduction of the euro. 12 countries fixed their exchange rate against in the new currency, and beginning in 1999, the new currency was used as a means of payment between companies and forged trade and bonds were our domination in it. The euro came to existence as real currency 2002 when the old notes and coin their 12 members countries were the withdrawn.